making a big deal about your child coloring outside the lines. So I'm not making a big deal about my algorithm coloring outside the lines by these little tiny little nodes of errant price action, where it just goes just a little bit outside of it because they're all coded too. That's where the damage is done. So I want you to focus on what the bodies are telling you. Inside those bodies, you want to measure that. Because the mean threshold of the bodies in not just single candle, but because they're consecutively up-closed candles, that makes the bearish order block. It's not just the last up-closed candle before the down move. That was the trap. I knew people would go out there and start using it and start pretending like they didn't learn it from me. Oh, it's Wyckoff. Oh, it's supply and demand. Bullshit. You have to take all of the candles because this is the state of delivery that was in play, buy side. Soon as we cross this opening price right there, that means the algorithm has changed, switched script. Now it's offering sell side. That means it's going to explore lower prices. Is it just going to randomly pull shit out of its ass and say, well, let's just go down here, let's go over here, or think about it like this. And I'm obviously being facetious and I'm being a dick right now because I want you to understand the fallacy in believing that there is no algorithm, that these things are just completely random buying and selling pressure. Pray tell, how the fuck are we going from the opening price here and we're trading up into that little range here, but we're staying below the midpoint, which is mean threshold. We are not piercing and going above that fair value gap. We stopped one tick below it. So it's like something other than everybody else's retail stuff. How is it that the market's going to reach back through all of this price range from that high down to that low? Where is it going to gravitate to? And why is it the same logic that I'm teaching and taught millions of people around the world? They're able to use this information and they're able to get funded account payout. They're able to trade with real brokerage firms, not some horse shit, real brokerage firms, and getting withdrawals and paid out. They're paying taxes on their trading wins. It's not market replay stuff, okay? How is it that the things I'm talking about and how the market will reach back to them, why does that occur more than anything else out there? And how is it that if there's so many things in this industry that you can use to trade off of, and yes, you can do that. You can trade on anything. Weather, like I made fun of yesterday, the lunar cycles and whatnot, the planetary alignments, all that stuff is nonsense. That doesn't make the market go up or down. It doesn't do that. So if there are all these different principles and disciplines of trading, how is it that the market agrees to use the theology around Elliott wave one particular day, or harmonic patterns this day, or Dow theory this day, or supply and demand this day, or Wyckoff this day? Because they all do not agree, folks. Study them. I have. I listened to all that horse shit in my first 3 years. And every bit of it is dog shit. It's dog shit. It's all dog squeeze. It absolutely has no bearing on what price is going to do. But it feels good having your faith placed in something, so therefore it gives that team mentality. And that's why everybody that's outside of my community, when I teach this stuff, regardless of how precise it is, regardless of how many people are making money with it, regardless of how many people have proven it works, not in my own hands, that's not enough. Everybody else that has done it and used it and make money with it. You have a huge daunting task of proving it doesn't work when you have such an army of witnesses proving that it does work. But everybody outside our community takes shots at me because I'm an equal opportunity prick. I'm going to piss in the cornflakes of everybody else's stuff because it all doesn't work, because they think it works. That's not enough. You can't sit out here and every single candle use your theology and explain why it's going to do it. And you can't call your shit beforehand and map it out all day long on a 1 minute chart. You can't do it. You'll have a hit and miss type thing. Once in a while it'll happen, but you'll champion that like a pony. Here's my pony show. Look at this. Here's my one trick pony win today. But it's altogether something when you're out here over live price action, not market replay, not hindsight shit. You have to be able to draw the analogies from something you have seen work for decades, that you had a hand in, that you authored. You get what I'm putting down? You getting it? Are you getting it? There's nothing like this because everything else is external to the market. I am the market. This is the actual source code. This is the stuff that goes on every day. And when they put their hands in there and they start monkeying around with it, you have to take a step back, wait for it to go back into doing its normal following its scripts. But we can identify when a script is changed. Remember that little scene in the movie The Matrix? They're inside the building, and they're inside the Matrix, if you will. And Neo sees that little black cat. He walks out in the opening of the doorway, and all of a sudden he sees it again. And he says, well, that's weird. You know, I'm having like a deja vu moment. And because they all realize that he noticed something. And true, yes, it's a movie, but the analogy is the same. They said, what did you see? And he goes, well, I saw a cat, and then I saw it again. He goes, oh, they just made a change. They just made a change. That's what this is doing, okay? Watch what's happening. The market trades up to a level you were told to anticipate yesterday as an upside objective. The fact that it draws to it is one part, but does it draw to it after creating relative equal highs, failing to hit it on the 8:30 news driver? Because I would have preferred, and while, truth be told, while watching it, I anticipated that to hit that. And I was surprised that it didn't. But all it did was stay inside the range right here. So they left that high intact there, traded just a little bit above that one there, and right in here. So what are they doing? What are they doing as a helping hand to the retail trader? Well, they're giving them what they're looking for, right? They're giving them resistance. So what are they going to do? They're going to try to sell short right at this level, or maybe just a little bit above once it starts moving in their favor because now they're convinced it's going to go lower. So where are they going to put their stop loss? Oh, that's easy. Right above where the book's telling, right above these highs. And if it's not a good enough point to do that, the ones that are real prudent, they don't want to get stopped out because, hey, they know enough about support and resistance that sometimes it goes just a little bit above it. So they're going to be really smart and put their stop loss right above that high there. Okay. Well, the algorithm knows that because those highs and lows are formed by it, not the buying and selling pressure. But it also knows the fucking shit that I gave you yesterday, which is the logic. It's going to go up to some random bullshit level found in another retail idea. Nope. New week opening gap right there. Bang. Then it overlaps it, changes the state of delivery from buy side to sell side. That means every premium array, everything that could be used as an ICT trader, smart money concepts that are used for shorts, anything that would prevent price from going any higher, that's what your eyeball starts looking for. Okay? But you go through the range. This is where we need the high. This is where we change the state of delivery. And now we're in a move that is in sell side delivery. That means you're in a sell program, folks. That means the market's going lower for the express purposes of repricing to any inefficiency. That means a fair value gap, buy side imbalance, sell side inefficiency, sell side imbalance, sell side inefficiency, or wick, consequent encroachment. Ooh, that is so good, ICT. That's starting to make sense to me. Good. From that high to that low, we can go back through and see everything over here and down into that wick. Where's the pertinent, useful information? Now think about this. Think. Because Wyckoff doesn't do this. Supply and demand doesn't do this. Elliott Wave has no fucking idea. He's still waiting for a wave. He's sitting out there on the surfboard waiting. The big Kahuna ICT is out here calling it live, riding the big wave. Calling every little tiny little tube. Going through it. You can see me out there. See it? See the sun glistening off the crest of the wave? You see that? Look at that. I'm not even getting sun fucking burned. It's beautiful. No sunblock necessary. I'm bringing the fucking heat. This guy's a character. So the high to that low, you go back through all of the price movement here. Okay, and what you're looking for is anything that was offered as a discount array when it was going up to that high, it will reverse its role. That's how I know which PD array to use as an inversion level. Okay? If we are looking for, in here, let's say it like this. See how we have a gap here, and we have a gap here, and we also have this down close candle. So we have a gap inside of the range of an order block. You have to look at that and think, okay, that's something we can use as a buy, and we see it there, and it was valid there, until we get to this high and over here. So this has been used there as a buy. So extending it further over here, what can we anticipate it acting as? Some form of resistance, an inversion. Okay, so as order blocks, they can invert, they can reverse their role, their characteristics can change. Just like these candles here are showing you that little glitch in the matrix, that deja vu moment where Neo said, I saw a cat, and I feel like I saw that same cat do the same thing. And the other members like Trinity and Morpheus and whoever else, the people, I don't remember their names, they were like, oh no, there's a change, we got to go. Because they know that the agents were in there making changes and they found them, basically. Okay, well, what you're doing is you're looking for these little changes in the algorithm. When price changes, it's routine. They're never, ever, ever going to be able to change this, folks. I don't know how to say it any plainer than that, okay? What they can do, let me make some devil's advocates. These little, okay, this is what could happen, but it still doesn't change it. It just means that you might take a trade with this information. And then they run that high one more time. Boom. Okay, well, you just got stopped out. That's all. It's happened to me before. It's happened. You watched me do it the other day. I was showing you my trade. I even told my son, I said, I'm going to show my trade. And as soon as I make my stop loss public, good old Phil, right to the stop, and then it'll go where I want it to go. But it doesn't change the fact that it was a winning trade. Okay. But the point is, if you get stopped out, you just got stopped out on that transaction. It's just one trade that's the outcome of that one. But you can't take your attention and say, well, this means everything's flawed and it's never going to work. So let me go find an indicator. No. It just means that individual transaction, like that one day driving to work and you got a flat tire, you didn't know you were going to get a flat tire. Is it possible you're going to get a flat tire? Sure. Are you going to stop going to your job pissed off in defiance because you got a flat tire? There must be something about that place where I work at. Fuck that guy. Fuck that person that runs that company. Fuck that company. Fuck all the time and tenure I put into it. I got a flat tire. Fuck them. I'm never coming back. That's what you're doing when you say, I'm going to work with a methodology, but it's first time it fails on me. I'm done. I'm looking for the offering. I'm going to change. I'm going to start looking. That's a system hopping. And traders that start out in the beginning, they do a lot of that. I did it. I ain't got no shame in telling you because I didn't know any better. But when you come here, when you're listening to me, I might not be so eloquent all the time when I speak. I may not be your cup of tea for someone to listen to around your children, okay? But I'm not going to give you bullshit. I'm going to give you the stuff that works. I'm going to cut to the bone marrow. I'm going to get right down to what matters most. And you think I'm not getting to what matters. You're not getting to the point, ICT. The point is you're going to fuck up if you don't listen to everything I'm telling you. That's the point, but you don't want to hear it. It's good medicine. It might not taste all that good, but swallow, okay? Swallow. It's good for you. So now, when this cross over that opening price, we're interested in seeing everything gravitate lower. So because I'm teaching my son incrementally to build in these objectives of just looking for small little modular moves. Small little modular moves. Let me get this off now because we've had it very long enough. The asshole over on Instagram pretend to be me with 200,000 followers, whether they're real or not, I don't know. I love pissing in his face all the time. So that level right there, it goes up and just touches. Well, it doesn't really touch really because that's the high. We were one tick away, a half a tick away, and a quarter tick away. in here, but didn't get into the fair value gap. It did use the breaker here, and it did qualify and prove that that change in the state of delivery, we want to see it roll over. It does. This wick, we talked about how when it went through that, the market's going to come right back up because it's going to use this reference point and this fair value gap and this old key price level at 6 p.m., the opening, because there's no difference between where we closed yesterday at 5 p.m., that closing price and the first print at 6 p.m., they're the same price. So you're just going to draw a line like that. You can annotate that anything you want. You can call it the 6 p.m. opening price, no gap. Or you can just say new session start 6 p.m. I don't ever have a name. It's just I draw a line, okay? So if I wanted to have a name for it, it'd be one of those. You can name it whatever you want. I'm sure it'll be in somebody's Amazon book and they'll talk about it. They won't credit me though. And then if I find out about it later on, because somebody's going to eventually buy the book and they're going to say, it sounds like ICP's bullshit. And then I'm going to hear about it in an email, and then I'm going to buy their bullshit. And then I'm going to go on their reviews and say, this is horseshit. It's all lies. Go to my YouTube channel in this fucking video, and you'll see that this is where they got it. And then nobody wants to buy your book, and they call you an asshole and a plagiarist, just like John Fibilotti did. So if we see that the market, it does in fact go down to our intermediate term price level, which is what? The first target below all the bodies. See all these candlesticks right here? So ignore this wick for a moment. Okay, see all that? All this range? Ignore that for a moment, okay? And say price only looked like it did with the bodies and not the wicks underneath them. So the market dropped down here, all these bodies, and then we started going up. I want to target something below those bodies. So what PD array do I have below them? Well, if I use this closing price here, that's a rejection block. You can use that. And I taught my students this. That's a level to aim for as a partial and see if we can get to it. And then hold on to it and see if it can go down and continuously move. But I didn't introduce every aspect about wicks. They're learning it right alongside of you right now today on August 14th, 2024 on live stream on my YouTube channel. You're getting it the same way at the same time. This wick, its consequent encroachment, is below the rejection block. So it goes without saying, if I anticipate the price run from here and in here going down to this level, we have to gauge whether or not does it have the ability to trade below it. We only do so for the wick. But remember I was telling you, watch and see, does the bodies confirm that level? It did, right? And then what does it do? It returns back to an old area of inefficiency and that old 6 p.m. opening price. These are all old friends, folks. How many times have I talked about those key points? They're not a zone, some ambiguous, what do I pick as a price in a zone, a supply and demand zone? If the range that creates that supply and demand zone is 15 to 20 handles, or 12 handles, or 8 handles, which one of those levels are important to you as a trader? Which one are you going to use? How are you going to use it for the purposes of managing with a stop loss? See, that's why it's nonsensical. Now, I'm not saying some people can't say, well, if it's a demand zone, just use the highest level. Okay, well, that sounds pretty good. And use a stop below it plus the range of the supply and demand zone, or some percentage of it, 1/4% of it or 0.5% of it as a stop. Okay, that's a pretty good methodology. Yeah, there's nothing wrong with that. But that ain't good enough for me. Like, I want to know. I want to know that I can put a stop loss on this son of a bitch, and I'm going to be in there. And it's going to take a real move. They're going to have to really come at me to take me out. Not just static price action, just normal volatility that is, oh, it stops me out. Like yesterday when I was live streaming, or was it Monday? I can't remember which one it was, but I showed my trade. And it went right up after I said, it's probably going to go up there and knock it out and fill with repricing and send it down to where I was aiming for. And it was like a go fuck you ICT in front of everybody. But that's all right. That's okay. I still beat his ass. And I'm going to beat you again tonight and tomorrow and next fucking week. It's going to be the same thing. It's fun. I'm having fun with it. It's sport. But it takes a real move, not just static randomness, because if these things hold logic that's valid, then they will work more times than they fail. Not just 60% of the time, okay, but the majority of the time. The majority of them. You can't have this degree of precision, these elements that repeat over and over and over again without it having some control mechanism in play. It's only being allowed to do certain things. And it is a facade. It is nonsense to try to make an argument that the random buying and selling participants of buyers and sellers, traders, at these price points, that we can see in advance. We can see this in advance. And then it books price this way. And it supports the underlying narrative that, okay, yeah, we moved from here down to there. The body supported it, said, okay, we're not closing below it, so it's rallying up. Did we take out the low? No. Did we go to the lower quadrant of that wick? No. They're still in play then. So if it's going up here, why is it going up? It's going back up to an ordinate efficiency, and it's reverting back to where the day started. The first print at 6 p.m. last night, New York local time. It crosses that again. I believe it would have done that even if that fair value gap wasn't there, and even if this wick wasn't there. That's something I would have expected. Regardless of anything else needing to be there, that's something I would expect, because from here going up higher, we don't have a gap here. We don't have a fair value gap there. We don't have a fair value gap there, but we have it there. So let's say that this wick here touched this candlestick's low. So there's no fair value gap that's shaded in pink. Okay. And let's say that wick didn't exist. Say the candlestick stopped up here. So the only information I would have is it's going up just to touch that 6 p.m. price again. And maybe bump, if this was the candle's body, this is your order block. So it might want to come back up and bump that again. But because we have the fair value gap and the 6 p.m. opening price, and we have this consequent encroachment, see how there's several layered things there. So right away, you know that it's reasonable to see it gravitate back to this, because that's the first real thing. That's a real level. If there's ever a question of what's the most likely level to trade to, when we're like when we're down here, I'm going to err on this side of going to that price level before the fair value gap, because what can fair value gaps do? They can stay open. Well, it sounds like you're making up bullshit. No, think about what I've been teaching you. If I'm short, if I'm bearish, and I see a fair value gap above price, market price, and if it goes up there, what do I want to see about that fair value gap? Do I want to see it close in? Fuck no, I don't want to. I've already told you that. I want to see the upper half of that, or some degree above the midpoint. I want to see it stay open. Why? Why do I want to see that? I want every fair value gap that's above my target when I'm short, and I'm still in a trade. I want to see some of those fair value gaps stay open, because that's telling me this is so weak, it can't even go back up there and reprice to it and then close it in. But because it does so here, it's okay. It doesn't change, it doesn't strip the efficacy of this methodology. It just means that, well, you know, we had the consequent encroachment here. We had the 6 p.m. price that acts just like a new day opening gap. But because there's no gap there, you just use the 6 p.m. opening price. You don't use the 5 p.m., you use the 6 p.m. Why? Because that's the first print. So the algorithm is going to go right back to that. If there's no gap, you're focusing on whatever the 6 p.m. There's no confusion there, is it? Is that complicated? No. Whatever that 6 p.m. price is, that's what you have annotated on your chart. You can annotate it any way you want. I just chose to use this. Again, I don't have this stuff on my chart. It's only for the purpose of teaching my son here. All these levels are in notation form, like writing it down on a little, like 9x5 yellow pamphlet, like little. I buy them from Office Depot. You get like 12 of them in a bundle. And every day I write the date, and I write down I'm looking for a sell program, looking for a buy program based on what I think it's likely to happen for the scenario. And then I write down any PV array that's going to be useful to me, what their price is, and the time. So I'm writing the time and the PV array with the price. So I have it in numeric format and labeling on my notepad, and my chart is completely naked. It's actually harder for me when I have all this stuff on the chart, because I end up spending more time talking or paying attention to the things I'm annotating for you as a student learning, and it distracts me from watching the actual price action, and especially over a live stream where I'm communicating, I'm teaching, I'm lecturing over something, and it kind of like takes my time and focus off of the real-time candle. So this month of August is a lot of this type of stuff going on, but once we get through August and September, I'm just going to be talking about what the individual candles are happening at the moment and where they may gravitate to, and all this other stuff, this the supported commentary and things that I feel that's necessary as I go along. I wanted to be speaking only about every individual candle that's forming, so that way Caleb can watch and see what I'm thinking about every candlestick as it's forming. Which brings me up to the point of Al Brooks. I am not teaching Al Brooks stuff, and Al Brooks doesn't use any of this stuff either. Okay, I talked to Tom Hugard, who is a student and fan of Al Brooks, and he himself said that there's no comparison. It's totally, absolutely not the same thing. So that's the new flavor of the month, where they're saying now I took his stuff because Al Brooks apparently teaches reading price action one candle at a time. He ain't reading it like this. I'm a new language that everybody's learning. Okay, I'm not reinventing the wheel. I'm not transcribing and translating something somebody else did. This is a whole new science. We're evolving. Okay, we're way beyond everything else. But if you want to collect that $5 million, go through his stuff and see how everything I'm teaching ain't there. Do your best, because it's either is or there isn't, and there ain't nobody out there that's like me. But you go through all of these PV arrays. Anything that has a gap, and we were talking about this one over here, and then you have a gap right there. So you have an order block and a fair value gap. So if I ever have a fair value gap and an order block that's inside the range, meaning that, see the high of that candle, the down close candle, the black one, and you have this candle's low, that's basically the same range. This gap is inside of the bullish order block. So what am I going to refer to? Am I going to label it with the gap levels, or am I going to use the order block? I'm going to use the order block. Okay, so I'll use this range here, and what you do is you take this is how you do it. All right, so initially when we went down below the opening price on this bearish order block, changing the state of delivery, so that means your mind turns to, okay, the market's going to just keep offering lower prices. It's going to have little retracements. It's going to have little pops up higher, but they're going to be short-lived. They're going to be very controlled. They're going to be stunted. They won't be allowed to be really protracted to the upside. And then once it gets to a level that I'm teaching you that the market will refer to, which is a premium PV array, every one that forms as the delivery is unfolding, they're salient too. But if there isn't an inefficiency in the price run going lower as it drops, whereas we end up creating one here, see that fair value gap that we've been talking about? That's the first fair value gap. This small little one in here, I wouldn't care so much about that. And the reason why is because it's still inside of the range of the order block that we extend over here. So this was used as a buy. We can see that here. And then when we went into a sell program, now the market's going to start going lower at this time. So the market goes up, we watch to see, does it want to get in this fair value gap? Remember what I was saying? When you watch the stream, you'll hear me say, I'm interested in this one. I want to see. I want to see. Why am I saying that? Because we're inside of a breaker. And it might be enough just to simply do that, trade into the breaker and not go up there. And it's actually a good thing for you to see where trying to be very, very precise and you having limit orders as your entry mechanism, you may not get a fill. So what do? You use the price delivery continuum theory. It means, okay, your time frame on a 1 minute basis here suggests that this is where you're trying to get in at. But if it starts to run without you, do you just say, fuck it, I'm going to start trading oil today then? I'm not thinking like that. I used to, as a 20-year-old, when I missed my only setup that I was anticipating, stalking and hunting. If it didn't give me a fill and it ran away without me, I was like, okay, I missed the whole thing. And I'm looking at moves that would be like $8,000 in the bond market. Okay, that's 8 full handles. They're trading $1,000 per handle. So to see a whole 100-point move, okay, just go one contract, that type of movement would literally be $1,000. It's $32.25, $31.25 per tick. Okay, so a full run like that, and if it's 8 of those, that's an $8,000 move. And a move like this in the bond, that means I'm probably missing out on $300, $400, less than $500. I've missed it. So therefore, I'm not interested in those $7,500 that could still be taken. In my mind, when I first started as a trader, and this is probably what most of you feel this way too. Oh, well, I need to know how to find these because I see it happening and then I miss the move. Or I chase it. I don't know when to get in. And I put my stop loss in the wrong place or I get scared out of it. I just keep losing. Even though I'm right, I know where it's going. I'm watching your live stream. You're pointing to where it's going and I'm taking trades. Even though I tell you not to do that because you're learning fear, anxiety, because you don't know what I know. And just because I'm highlighting something doesn't guarantee it's going to happen. And if you're trying to pass funded accounts and trading 15 contracts because they say you can afford to do so, you can still do it wrong and be right in your direction. That's very frustrating. And you're not going to blame yourself for breaking the rules. You're going to say, I'm an asshole and this stuff doesn't work. But you sit down with me and we'll see that you didn't listen. I've had students that try to do that shit. Show me your logbook. Show me what you've been doing. Show me your trade entries and show me why you got into that fucking trade. As soon as that question comes up, the conversation ends. Because they know they don't listen. Just like I didn't listen. When I first started codifying rules around these ideas, I tried to make excuses for, well, I'm going to try to be outperforming these rules. I'm better than this. Okay. And I never established a baseline to trust initially. So I had to force myself to go through that stuff. And you have to do the same thing. And I'm forcing Caleb to do that. As you can see, he's not getting an easy way. He's getting the woodshed shit just like all of you do. There's a lot of things. And you have to figure out where your model is in all of it. And you don't need to have every aspect of what's available to me as the creator of this stuff. You just have to have little compartmentalized segments of price movement that makes sense to you, that's logical, it's reasonable to anticipate forming at the time of day that it should behave that way. So at this point, we start looking for every possible reason for price to trade down. Well, this area here with the order block, it's in close proximity to where the start of the move would be. So are you going to have that on your chart and have all that much interest to it? No. You do want to see it trade below it, which it does here. So at that point, I'm not interested in that one. So what's below that? We have this gap right in here, which was already used. Yes. Watch. This is all trading inside the range. Okay. I'm going to change the color of this a little bit. Well, actually, a lot wouldn't be. This is your gap here, which it trades down to it here. Why is it trading with that little, I call it a mohawk, where it colors outside the line? Why is it doing that? Because there's an overlap of that candle's wick and that candle's body. So that's a balanced price range. So it's just validating that. It just stops it like a you will not pass. You're not going any further. Okay. And that's why that little mohawk stops there. 90% of the mohawks that I anticipate where the market trades just outside of a PD array, I can see them. I can anticipate them. There's logic behind them. I'm not going to teach you all that stuff. And that part won't be in the book. Okay. So I want you to know that there's a lot of things I'm not going to teach because I'm just not going to do it. And I don't give a fuck who asks and twists my arm and calls me before them. I am not teaching it. Done. Okay. So you can see how the market uses this fair value gap, which becomes what now? Let's say that you are a fan of the concepts that I'm teaching and you really are resonating with them. And maybe some of the things I'm teaching, it just doesn't jive with you. You're like, I can see when you point it out, but I wouldn't have saw that. Okay, Don't beat yourself up about it. What are you noticing in price action? What do you see? Because last year on Twitter Spaces, when I was teaching the concept of inversion fair value gap, not every fair value gap becomes an inversion fair value gap, by the way. Okay, and there's a young man out there that's very overzealous about inversion fair value gaps, and it almost implies that he created himself. But I understand your enthusiasm and you're overzealous, but not every fair value gap becomes an inversion fair value gap. Okay, but if you didn't know the logic that I'm teaching today about the wicks, okay, if I didn't teach that and you didn't know anything about it, and there wasn't this gap here in the pink, say that didn't exist in this price time right here, and there wasn't a 6 p.m. opening price that we would reference anyway, and say that was the case, and that we still started retracing here, what would we be using then? That gap extended over becomes what? Inversion fair value gap. And what would we want to see with that logic, ICT? Tell me something that you didn't change and change the logic around it. It's got to be consistent, because if it's changing, you're bullshitting everybody. And I'm getting lucky over live price action. That's what it sounds like, okay? To some of you, that's exactly what you think. But listen what I have said many, many times. If this is the gap here to here, extend it over, look at that little square right there. That's the midpoint. That's consequent encroachment of what? That gap that is now going to be expected to be what? An inversion fair value gap. Do we want the inversion fair value gaps to close in entirely? In other words, if it trades up to the low of it, do we want to see it trade all the way up to the top and touch that? No. Why? Because every inefficiency, if I'm short and it's trading back up into it, I want to see the upper half or some portion of the upper half of it stay open. I want to see that. Why? Because I've been talking about it since last week. Every array that is an inefficiency, if it's a gap, if it can't fill the gap entirely, and I'm short, and it trades up here and leaves a portion of it open, that is telling you the clearest, loudest way to say this market is not going up. It's weak, so start looking for lower targets. It's going to go lower. Is that a hard, complicated thing? No. Am I changing the theory around it? No. Is it manifesting itself here? Yep. So it doesn't matter if you didn't have the 6 p.m. It doesn't matter if you didn't have this fair value gap. And it doesn't matter if you had this wick here. If you didn't have any of those things, once it started coming down and we're in a sell program, I would be extending these things over here. That's what I use with market maker sell and buy models. That's how you're using them. You go back through the range. Okay, back on baby pips. I was going to start leading myself into some of these lectures, but not to the degree I ended up doing with the paid mentorship. I never intended to teach all that stuff, but it became fun, revealing more and more and more, and I got addicted to everybody's astonishment, and I got whipped up in the frenzy of it, and it was fun. But just know that there's a limit to how far I'm going to go with it all, but there's a lot more that I'm going to share. But in here, going back from here to that low, I did a lecture on baby pips. It's called Trading Inside the Range. And I started to teach the beginning elements to some of these principles. And at the end of that lecture, I actually had anxiety about having done it because I didn't feel comfortable revealing it. I didn't feel comfortable doing it. And it took time, putting my toe in the water to see what would happen if I revealed a little bit more and revealed a little bit more and revealed a little bit more. And over the years, it's a lot out there now, but I had to make sure that I have a language that I can lean on as this is what I'm teaching. This is what I'm showcasing. This is that, okay? But there's nothing else out there in retail that this is what it's replicating or duplicating or borrowing the logic of. And believe me, $5 million is a nice chunk of change. And if it was possible to be able to say that this stuff is renamed, rebranded, called something different, thousands of you would have came forward with it. And it's not happened. So there you go. There's your obvious testimony that anybody that says that are just parroting other people, or they're trying to sell something and they're trying to just take the attention and the momentum around what it is I'm giving to the community because they want to sell their bullshit. Hey, I understand groceries are expensive, but you go back through all that range and you start looking for where it acted as support, where it was discount, where it sprung price higher like a trampoline. When you start going down, because you're in a sell program, why? Because he has to change the state of delivery here. Everything starts seeking lower prices. It's not just simply, well, here's the support, let's just go there. That's not enough for me. Because how will you, if you're here and you expect it to trade down, it's not going to do that in one shot. Can it do it? Sure it could. It could have a big candle just fall out of bed and go down there. But you won't be able to trade those kind of environments anyway, just like this kind of day is, or this kind of individual candlestick. You can't trade the PPI and CPI number. You can't enter those candlesticks. And many of you probably already discovered that you can't even use the paper trading platform on TradingView when you have these big reports because they're lagging. Like there's no, you can't even do anything with it. So, which is kind of a good thing because, you know, that keeps a lot of the fakes out there from saying, look, you know, I did 50 contracts on this on gold and look where my fill was. You didn't get filled on that shit. So you go back through all of this price range and then you have this gap here. So let's make a notation of that one. You have that. And look where the bodies are stopping in there. See that? Yeah, we go up into that fair value gap because it's there. So every new array that forms, that means any short-term high, any bearish up-close candle, which is an order block, any gap, like a fair value gap, all of them have to be referenced. My attention, every time it forms a new one in the new sell program, they're most important to me. If they agree and they converge with something inside of the buy side of the curve, which means while it was going up, if it matches, then there's going to be a lot of weight associated with that. And I expect price to remain heavy. You ever notice when I'm talking about in trades where I'll comment and say, I'll type it out and say, I want to see speed and distance, or I want to see large range candles. Those are indications in my mind because I'm seeing things like this where, okay, there's a fair value gap over here that acted as something bullish. How do we know that? Because look what it did here. Traded down to it here and then repelled price higher. Okay, that's not support and resistance. It's the logic that that inefficiency stayed open. You see that? It didn't completely come down to that candle's low or at that high that candle, which is the low of that fair value gap. That's what you want to see. If you're going to try to buy a fair value gap and the market's bullish and you're right in where you think the market's going to trade to, you're buying the fair value gaps high or something just above the consequent encroachment because the likelihood of you getting it consequent encroachment or just below it and being filled is very small. Can it happen? Absolutely. If you do, you'll have one of the best fucking entries. And that's the one you can go on Instagram, go on Facebook, put advertisements out and say, I'm selling a course. Look at this. I learned this bullshit. That's the ones everybody wants a dog and pony show. But it's a steady diet, even in my own hands. I don't get those types of fills. So I have to use a very low threshold of entry. That means I'm going to use the easiest barrier to break through. I'm going to use the high of a fair value gap that's going to act as support for me. I'm going to buy that discount array at the high of the fair value gap or one tick below the highest part of it. And I'm going to try to get my largest portion on there. If it trades to the midpoint of a fair value gap and I'm bullish, I'll add on another portion and I'm not afraid of it. If it leaves that fair value gap and comes back down one more time, tests the consequent encroachment, I will add to that trade again. And if you look at my trade examples, they're all over on Twitter, the ones that don't have, I put songs in there because I love music, okay? And the trades that I'm taking at the time, I'd like to use a song that I was listening to, and because I would take the trade and condense it by speed because you only had to have, I think it was like 1 minute and something over there on Twitter. It used to be that was the timeline I had to, or time limit it had on the videos. I thought I was safe by using the music over there, but I don't sell like engagements over there. Like I didn't make money by having people watch what I do. Like I didn't monetize that over there. But the artists would obviously, put copyrights against me and they take the videos down. That's why I told everybody when I was on Twitter, I said, if you like these things, download them because I was always getting suspended on Twitter last year and year prior because the artist or the management company that holds the rights for their songs, they were making Twitter, or X now, remove the video because it had a song in it. To me, that's a dick move because I'm not even monetizing it. Like, I'm literally giving the credit to the author of the song, and I'm a fan of it, and it's just me just doing something with no money. I'm not making money off of that.